are some pitfalls you can avoid when planning for Medicare's income-related monthly adjustment amount? Well, here to talk with me about this is Robert Klein from the Retirement Income Center. Robert, welcome.
Thank you, Bob.
So, where to begin with this topic of avoiding pitfalls?
Well, first, just briefly talking about what happens when you turn 65, because before then, you're paying your health insurance premiums and it's based on a number of different factors. However, it becomes simplified when you turn 65 in that your premium amount is based exclusively on one factor, which is your income. And specifically, it's all about a concept called modified adjusted gross income, which is a tax return concept. Most people are familiar with adjusted gross income. Modified adjusted gross income is adjusted gross income with a few different adjustments, but for all practical purposes, in a lot of cases, it's identical. So depending upon what your monthly adjusted gross income is, that determines your premium. So here's how your Medicare Part B monthly premiums are determined. On the left-hand side are different brackets for modified adjusted gross income. And furthermore, it's divided up as to the type of tax return you're filing, individual, joint tax return, or married filing separate. For individual returns for income brackets between 0 and 91,000, you pay the basic Medicare premium, which currently is $170.10. If you're filing a joint tax return between 0 and 182,000 of income, it's the same premium. So it's not until you get into higher income levels that you're exposed to what is called IRMAA, the income adjustment. And so that adjustment, as you can see, starts at $68 and goes up to $408.20 when your income exceeds $500,000 if you're single, or $750,000 married filing joint. So that can add quite a bit to your monthly premiums.
So, Robert, the table that you just put on our screen, that's for 2022. Obviously, the IRMAA rates will change for 2023, which would be based on someone's 2021 modified adjusted gross income.
Yeah, you bring up two topics there. The 2023 Medicare Part B premium rates have been released, and they're going to be slightly lower than 2022. The second point you bring up, which is really important in calculating the IRMAA, you use your tax return from 2 years prior to the current year. And so your Social Security Part B, Medicare Part B kicks in when you're 65. And so the first time you're exposed to this, when you're 65, you're pulling income from 63, 2 years prior to that, to determine what your IRMAA Medicare premium will be.
So what are some planning opportunities given all this?
So as far as planning opportunities, first thing is to keep in mind is, okay, the question comes up, when should I start planning for this? And my contention is no later than 63, because that's the first tax year that's used to determine your Medicare Part B premiums for when you turn 65. And furthermore, I recommend you start when you're 60 if you're going to have a transaction when you turn 63 or later. And furthermore, I just think it's good practice and it's easy enough to do. You start even sooner than that. If you know you're going to have income such that the levels are going to exceed the IRMAA thresholds, i.e. 91,000 if single, 182,000 if married filing joint. And that can easily happen between, if you have a lot of taxable Social Security, if you're still working, have W-2 income, self-employment income, as well as other sources of income.
Right. And you talk about this notion of not planning for IRMAA in a vacuum. Talk more about that.
Yeah, I found that a common pitfall when you're planning for IRMAA is, whether you're a professional or a non-professional, is to focus exclusively on IRMAA as a planning obstacle, if you will, and either focus exclusively or just too much on it to the point where you're not looking at the other side of if you're planning for a long-term transaction that's going to have some, substantial long-term benefits. Sometimes people get caught up in this pitfall where they're just so focused on the IRMAA that they're looking at the jumps in the brackets, and if there's too much of an increase in IRMAA, they might not pursue a particular transaction. And I give a couple of examples in my article. We'll just touch on them. One is sale of residence, where you can have a taxable gain when you sell a residence, even if you qualify for the sale of residence exclusion, which is either 250 if you're single or 500 if you're married. And if you have a large taxable gain in a particular year, 2 years later, you're going to potentially have an increase in IRMAA, which could be substantial. So it's definitely important to plan for the IRMAA and look at, okay, what is my increase going to be 2 years from now? But you have to, as always, keep the big picture in mind. And in particular, as it relates to the sale of a residence, you have an opportunity to realize a sizable gain in a lot of cases. That's the first thing to keep in mind. Second thing to keep in mind is that the IRMAA increase attributable to the sale of residence, although it could be substantial, is a one-time event 2 years from now. Let's say you sell your house in 2022, 2024, you hit with a large increase. 2025 is a new ball game because you keep looking back 2 years before the current year to see what your IRMAA is. So unless you have some sizable transactions, a lot of adjusted gross income in 2023, 2025, your IRMAA could go down substantially. And then when you look at it in terms of the additional IRMAA as a percentage of the selling price of the residence or the gain, it's typically very small.
Yeah. What about Roth conversions? Is that also another thing that folks should think about when they're doing IRMAA planning?
Yeah, but once again, don't overthink about it necessarily, because it's a situation where it could be if you just do one Roth IRA conversion in 1 year, it could be a one-time thing. However, a lot of times with Roth IRA conversions, a lot of people are doing staged Roth IRA conversions where they're doing multiple conversions within a year or over several years. And so there's more of a planning opportunity with that type of situation to either, and I recommend this highly, start your Roth IRA conversions early before you even get close to 63, and or spread them apart so you can include chunks of income, additional income attributable to the Roth IRA conversion, and you can minimize the IRMAA as a percentage of the IRMAA increase, I should say, as a percentage of the your taxable income that you're going to pick up. And also with that, you need to think about, once again, the big picture here, which is really important. Why are you doing that Roth IRA conversion? What are the benefits? And generally speaking, there's three benefits that are extremely important. One is elimination of taxation on not only the converted amounts, but a key component is the future appreciation. You're eliminating taxation there. Second benefit is the converted amounts, including the appreciation, are exempt from your required minimum distributions beginning at 72. And third, but not least, which is particularly applicable today, is you're potentially paying tax at a lower tax rate than you will when you start taking income from your IRA accounts. So it's really important to keep those benefits in mind when you're looking at your IRMAA planning. And try to control the IRMAA amounts, but once again, look at the long-term benefits to be obtained from a Roth IRA conversion.
Yeah. Given the complexities of IRMAA planning, there's a need to work with a qualified professional on this sort of thing?
It makes sense. If you're doing retirement income planning and you're doing tax planning anyway as part of that, which you should be, it's easy enough to incorporate the IRMAA planning. You just have to keep it in mind and once again, look at your particular situation and start it at the appropriate time. Don't necessarily wait until you turn 63, let alone 65 to do the IRMAA planning. Get it going. And to the extent you're working with a professional doing retirement income planning, I would expect that that would be a part of your total planning.
Yeah. So one curveball question, we often talk about IRMAA as it pertains to Medicare Part B. Oftentimes someone also has Part D where maybe they're paying a $0 premium if they're below the thresholds, but IRMAA can also affect folks who their Part D premiums as well.
That's true. Yep. Obviously Medicare Part B is much larger than Part D, but it's important to keep that in mind as well.
All right. So we covered a lot of ground. Robert, anything we missed or anything that bears reemphasizing?
Just a couple quick things. One thing is the timing of the payments of the premiums for Part B. In my article, I referred to the fact that they're paid on a monthly basis. However, people who start their Medicare at 65 and haven't started their Social Security benefits yet will need to pay those by check on a quarterly basis. That's one thing. Second thing is to always keep in mind when you're doing IRMAA planning, Social Security planning as part of this, because these days it's not uncommon that taxable Social Security benefits are a pretty good chunk of adjusted gross income between the COLAs, the cost of living adjustments in 2022, 5.9%, and in 2023 it was just announced 8.7%. And combined with if you defer your start date at Social Security to age 70, you could end up with a pretty sizable benefit that can quickly, when combined with other income, expose you to higher potential IRMAA surcharges.
Yeah. Robert, it's always a pleasure having you share your knowledge and wisdom with our readers and our viewers. It's greatly appreciated, as you know.
Thank you very much, Bob. Appreciate it.